All right. Well, I think we're 5 past, so I'm going to do a quick introduction. Welcome, everybody, to the second edition of State of Flex. The first one was a blast. We did it in August. I think my favorite parts was that not only did I find what Debbie and Nick shared be incredibly insightful along the way and led to rich discussion, but in the chat, there was really good discussion. There were people answering each other's questions in the Q&A, and that was fun. And so I hope we have the same kind of dynamic where there's different conversations happening in different places at the same time. It made for something that I thought was really fun and really insightful. A couple of notes before we get started. First of all, I'm incredibly appreciative that Nick and Debbie are here with us again. We'll do more of an introduction for them as we get into their slides, but Debbie, one of the leading thinkers, senior partner at Boston Consulting Group, doing fantastic work around flexible work and evolution in this topic. Nick at Stanford, obviously done a ton of work on this in a bunch of different facets, and close collaborators of ours. So thank you both for being here. I'm excited to do it. A few housekeeping things to note for everybody before we get started. One, the format today will be 3 kind of 5 to 7 minute quick presentations. We'll each do 4 slides on a few of the things that we think are most interesting right now in flexible work and different topics. We'll then have a good 30 minutes for Q&A and discussion afterwards. So it should be about 50-50 balance. After we do the slides, we will attach a PDF of the slides also into the chat. So if anybody wants to go back, look through, that stimulates questions or discussion, happy to dig deeper into that stuff. So expect that in a little bit. You can ask questions in the Q&A. You should see at the bottom of the Zoom tab a Q&A link. You can both ask questions. You can thumbs up other people's questions. That's actually super helpful because it helps us figure out where to prioritize and what things are really on folks' minds. You can also type answers to different folks' things. And so please feel free to engage there as well. As Brian said, we can also just chat there if you're interested in just hanging out and talking to Brian. That's also possible to do in the Q&A. And so please feel free to ask whatever's on your mind. I promise if you are thinking about it, there's probably somebody else who is also thinking about it. So there are no bad questions. Debbie, Nick, anything I forgot on the front end from a housekeeping perspective?
No, I think that's good.
No, right. I already saw there was already one great question on how do we know lizards don't get lonely? I'll answer that later.
Nick, I'm very interested to hear your answer on why on lizards and loneliness. All right. I think we are sharing the slides. Hopefully everybody can see that now. Okay, awesome. All right, so I will do a quick introduction of myself for anybody that I haven't met or spoken with before. So I'm the CEO and co-founder at Scoop. Scoop is a software and data company. We build software to enable hybrid and distributed teams to make better decisions around where they work and how they work. We also produce the Flex Index, which is a global repository of company office requirements. We do monthly reports on different topics, one of which I will talk about that we did this week that Debbie and I collaborated on with some revenue analysis. Flex Index has been fun to build. It covers 7,500 companies now. They have more than 55,000 offices in the US. Those companies employ more than 100 million people globally. So it's a pretty good data set for us to look at trended data and triangulate with things like Nick's data at WFH Research. Other than that, I do a podcast called Flex Perspectives. I've interviewed Nick for it. Debbie, I'm going to get you signed up where we talk about the latest kind of insights and different things happening in future of work. All right, so first slide. We released our latest data for the Flex report on Tuesday. And so the first thing I want to talk about is just what's the current state of flexibility, specifically when it comes to work location flexibility in the US. So today, about 62% of companies on an industry weighted basis offer work location flexibility. That's up 1% quarter over quarter from when we looked at this in Q3, and it's up 11% year to date. If I look at the different groups here, and you can kind of see it in the chart, fully flexible companies represent about 1/3 of US companies on an industry weighted basis. When I say fully flexible, that means companies that do not require their employees to spend time in the office. There are 2 types of requirements that we capture there. One is fully remote. About 7% of companies on an industry weighted basis are fully remote. That's been pretty consistent year to date. We're not seeing much movement in the percentage of companies that are fully remote, meaning they have no offices at all. Employees' choice is the lion's share of those fully flexible firms. So those are companies where they do have offices, but employees are not required some set amount of time to come into the office. That's 26% of companies. It's up about 2 points year to date. The second big group, which is another kind of like 30-ish% slug, is structured hybrid companies. So structured hybrid means that the company sets an expectation on how much time to spend in office. It's not full-time, but it is some part of the week. The most common model there continues to be minimum days a week. I think one of the reasons why that's become quite popular is it allows the company to set guardrails on time spent in office. 2 days a week or 3 days a week is most common, but then teams can optimize and find themselves within that requirement in terms of specific days or giving team flexibility. So that customization at the team level, I think, is quite powerful. And then 38% of companies, I said, are full-time in office. That's down from 49% beginning of the year. If you go to the next slide, Kate, this is a new look that we did for the first time. It was actually Nick's idea to take a look at it, which was translating the office requirements into effectively what that means in terms of how much time on a weekly basis is required in office. You can see that it's pretty polarized. 33% of companies we code as requiring 0 days per week in office. That would be the fully remote or the employee's choice companies. 38%, as I mentioned on the previous slide, require full-time in office, which we code as 5 days a week. And then you can see the structured hybrid firms. The way we do this is whether it's min days a week or specific days a week or a minimum percentage of time, we translate that into amount of time in the office required per week out of 5 days. And so you can see the group that's 1 day versus 2 versus 3 versus 4. One of the things I find particularly interesting about this is I don't think there is much value for firms in choosing 1 day a week or 4 days a week as your office requirement. And there's a couple of reasons for that. If you pick 1 day per week, you are viewed as less flexible than all of the companies that are fully flexible, but you are not generating as much time together in office as the average structured hybrid company. So you're kind of a tweener in a sense where you don't get quite as much value in either direction, whether reputationally or in terms of like shared coordination time. And so that's kind of an interesting thing, I think, about the 1 day a week. On the flip side, the companies that do 4 days a week, they don't get a lot of credit for being flexible. They're less flexible than all of the fully flexible ones and most of the structured hybrid ones, but they're also not full-time in office, which may be the intention or the desire of a lot of the executives at those companies. And so in some ways, if I were to give guidance, I would say, if you are going to be structured hybrid and require some time in the week, make it 2 or 3 days a week on average. That's what most companies are doing there. If that's what you're trying to do is find some level of balance between time in, time out, be toward the middle. Otherwise, pick a side and either say we're going to be fully flexible, or if you really believe in full-time in office, go that direction, relative at least to what we're seeing in the peer set. If you go one more, one of the most interesting conversations that I hear comes up a lot in the media and otherwise is the situation right now in the US that companies are increasing the amount of time they require in office, but employees just aren't doing it. And as a result, the reason why occupancy rates have been relatively flat year to date, according to data sets like Castle, is because employees just aren't kind of complying with the mandate, so to speak, in terms of time spent in office. So I wanted to dig into this, and we looked at it a little bit and compared Flex Index data with Castle data. So what you see here in the blue for Flex Index is for companies that have a minimum days per week requirement in office, how many days a week has it been, and how has that trended January to October? You can see it's pretty flat from 2.49 in January to 2.54 in October. If you were to think about this on a 5 days a week basis, it effectively means if most companies had an unwritten policy of everybody works in the office 5 days a week prior to pandemic, you're kind of at 50% of that in terms of policy expectation now, 2.5 days versus 5 days. Accordingly, if you look at the Castle data on occupancy rates, that also has been about 50% year to date and has been totally flat since January, starting at 50.4% and then October 50.3%. So the point here is that policy and occupancy rates are effectively moving in lockstep. Policy is effectively 50% of what it was pre-pandemic. Occupancy is effectively 50% of what it was pre-pandemic. The answer here is not that if companies enforce more aggressively, they're going to see a lot more office time. Policy would actually need to move in order for that to happen. That hasn't been happening year to date, but we'll continue to watch that. And I think that would be the only kind of leading indicator for seeing higher office utilization rates. And then the last thing I'll share, and then I'll pass it over to Debbie, and it's a good segue because Debbie and I collaborate on this analysis. I think it's been a bit of a holy grail for me and for Debbie and for others to try and better understand this question around productivity. And do flexible employees or flexible firms see higher or lower productivity? In some ways, I think about this as a bit of a Rorschach test. There's a lot of different studies out there. Nick can go on for a long time about all the different data points around hybrid and fully remote. Are they more productive or less productive? But one of the things we were curious about was, can you actually tie this to financials in some way? Like if one of those firm types was more productive than the other, would it show up in top line growth and revenue? And so we took all of the public companies that we had data on in the Flex Index. BCG did a bunch of analysis, Debbie's team, to look at revenue growth 2020 through 2022 for those companies. We then industry adjusted it by looking at each of those companies' industries and making sure that we weren't over slanted one way or the other in a way that would actually influence the analysis. And we found a pretty big difference. We found that fully flexible firms were outpacing not fully flexible firms by 16 points in revenue growth over the 3-year period. And even if you break down that not fully flexible group, companies that were structured hybrid were outpacing by about 2x the companies that were full-time in office. So this is just a first foray into tying financials and flexibility together. We're really interested to look at earnings and operating margin and shareholder return. There's a bunch of things to do there, but it feels like an important first step and pretty exciting finding. One of the other things that we're going to look at is what might be driving this around engagement for talent, ability to attract more effectively, retain more effectively. There's a bunch of different hypotheses that we'll explore in terms of what's driving this.
Right. And also just like, what does it say about a company's culture of trust? Right. So is the policy driving it, or is the policy indicative of a broader set of issues that's driving it? But yes, so much to analyze. Thanks, Rob, for sharing that. So maybe I'll transition. And Rob, you did a good job of introducing me. So we could go to the next page to just set a little bit of the context, because I know this is about, this is a talk about flexibility. And I sort of broaden it out, and you saw on the page before, I stopped calling it the future of work and I call it making work, because it's not the future, it's now. And if you think about the 3 macro things, flexibility is just one of them, right? The data Rob shared and Nick will get into about flexible work, that is just one thing, and that's here to stay. And you saw Rob's data that it's pretty flat, it's not going away. But I think there are 2 other dynamics that we need to think about as well. One is what I described as the war for talent's over. Talent has won, which means we need to think about talent as customers, which means really deeply understanding their needs and motivations so we could attract, retain, motivate, not quiet quit, to get the most out of the people. And I'll talk a bit about that. And then also generative AI that is changing what work is. And so, so when I think about work, I think about, we have to think about making it work and rethinking what everyone does every day between 9 to 5, 8 to 6, 7 to 7, whatever the workday is, to make it both more productive, which are the numbers we're trying to get to show, because that's what convinces leadership teams and CEOs to rethink what work is, and more increasingly, and I'll talk more about this, is to make it more joyful. And I think people used to, believe you could have productivity for the office or joy for employees, and that's a trade-off, right? It's one or the other. And what I wanted to show in my work and my research is that there's not a trade-off. In fact, you could have both. And, by productivity, take productivity to be broad. It's, it could be revenue growth, it could be profitability, it could be productivity, it could be cost, right? It's value for the organization. And take joy to be broad. It's, what it means to employees. So at BCG, where I work, what drives joy is sense of accomplishment and impact, right? Joy in other places could mean I just have fun with the people I work with, right? The question is, do you enjoy work? Is what we use to do that. And so that's what we've tried to research. And so we did a survey we put out there, a follow-up to the survey we did last time we had one of these talks, and I shared that data. So this data is hot off the press. My team is still cranking it, and we have not published it yet. So this is first look. And, maybe just on the next slide to make the point, the war for talent is over, talent is won. With all the talk of recession, right? You see the macro data points. This has not changed. We asked all respondents, and this is for office-based workers. So it's not what we call deskless or frontline workers that have to be in a factory or have to be in a retail site. These are for people who, like I can, bring my laptop home and work, which is what I'm doing right now. Well, guess what? We asked them, are you looking for a new job? 3 categories: actively, passively, meaning if someone calls you up, would you take the call? Or no, not looking at all, I'm happy where I am. And you could see, almost half are at risk. And, when we tried to see, does it differ by different segments, minority segments? And it's actually pretty similar. It's pretty similar. There's a microscopic, statistically meaningful difference that, some diverse segments are slightly higher in being at risk. And you could see the numbers there, but microscopic, it's about half, right? And then on the next, so talent is at risk. At the next page, if we could look at, this gets to the issue of joy. The issue of joy. And when we looked at people, we surveyed everyone and we said, overall, how much do you enjoy work? And how effective are you at your work as a proxy for productivity? And we found those who said they're not effective versus effective was very little difference in attrition risk, very little difference in attrition risk. But those who said they have low joy at work, they don't enjoy their work, and those who enjoy their work, look at the difference in retention, right? For the folks who are not looking to take another job, it goes from 34% to 68%, which may be like, duh, it's obvious. If you like your work, you're not looking to leave. But for leaders who are so focused on productivity, especially as we introduce generative AI, right? All that productivity seeking behavior does not drive retention, What drives retention is, can we make work more joyful? To the simple question of, do you enjoy your work and how you bring it in? We also in the survey break down different aspects of work. And we ask, do you, describe how much time you spend on these different types of work. And we say, do you enjoy them? And are you effective at them? And then when you do the correlations of how does joy of one individual task drive overall joy on the left, you could see what's driving it is affiliation and culture and interactive work. So really, being with people, interacting with people, whether it's online and remote interaction or in-person interaction, is what drives joy. We are human creatures. And I don't have it on this chart, but if you look on the next chart, you'll see we ask people how much time they spend on the different activities. So here you have the vertical axis is how much do you enjoy those different pieces of work, and the horizontal axis is how effective are you at it. And so you could see the 2 things that drive enjoyment, drive joy: interactive work and affiliation culture. 2 things about it. On affiliation and culture, they're only spending 3% of their time. Interactive work, 17% of their time. So 20% of your time at work is driving your joy. So how can we invest in either growing those bubbles by shrinking others in terms of where you spend your time, but also making them more joyful? So affiliation and culture, look how low that is on the vertical axis, right? We're not doing it well. And that is the single piece that drives enjoyment of work overall the most. And maybe we should stop thinking about it as something you do off to the side, but bring it in to some of those other bubbles, and make, the interactive work more joyful, the mentoring more enjoyable, right? The focus work more, how can you make it more affiliative and have connection, right? Through the different parts of work. The other part that I thought I'd point out is administrative work. 25% of our time in soul-sucking administrative work, even though we're pretty effective on it. To the right, it's to the right of the charge. So again, as we think about making work, reinventing what we do every day, both in terms of flexibility, but also in terms of joy, because that drives retention, and also in terms of where do you apply tools like generative AI. The admin work is just screaming for there's got to be a better solution so we could get more time into the interactive work and the affiliation and culture that drives joy, which drives retention. All right, I'll leave it there and pass on to my friend Nick.
Thanks very much, Debbie. That was fantastic. It was great to go after you and Rob. So why don't we go on to the next slide? Thanks. So I was going to say, I went for a slightly different take this. We do this every 3 months. And I decided to talk about the impact of work from home and hybrid on US cities and the economy and globally. I tell you why I did this. I was actually in Las Vegas on Monday. I went to talk at Franchise Times. It has a huge event for thousands of people that run restaurants, franchise operations. And I actually spoke after Patrick Boyle, who runs Restaurant Business International. So they run like Burger King, Popeyes, Tim Hortons. So I was kind of thinking, so what has this done to the economy? So I'll go through 3 or 4 slides on this. So the first thing is we have strong evidence of what's called the donut effect. So I'm showing you data for New York, but we have data for across the US and actually right across Europe and into some Asian cities. So on the left is data from the United States Postal Service. It has incredibly detailed data of how many people came and went by zip code by month. So why does the US Postal Service have this? It has this because it tracks your mailing address. So if Debbie moves house, it wants to know because it's going to sell it to marketers where she lives. And if all her mail stops going to one address and starts turning up at another, even if she never informs the Postal Service, they figure it out. So they have the flows by zip by month. And what you see, what we've seen across big cities is people left the city center and moved out to the suburbs. And it's kind of obvious why. So Rob, I think you're in New York right now, but maybe we can come back to it in the Q&A. So it's kind of obvious why this has happened. If you only have to go into work 2-3 days a week, as we saw from, back to the beginning, Rob, has kind of become quite standard. You don't need to live in the city center, and you maybe want a bit of space for a home office in your backyard. So, finding one is around the world, people have left the city centers, moved out to the suburbs. That's why relatively suburban rents and suburban property prices have gone up, and it's fallen relatively in the city center. So San Francisco, near where I live, city center apartments are about worth 5% less than pre-pandemic. Inflation is about 20% since then. So you've lost about, a quarter of your money at least in that investment. So next slide, thanks. So something else this has impacted is not just where people live, but where they're spending money. So I also have very detailed data from MasterCard. I've been working with MasterCard, looking at spending data by zip code. And what we're here is showing on the left is change in spending data. This is, sensitive information. We can't show you levels, but we can show you changes. On the left, what we can see again is there's kind of a heat map of spending in the center of New York was down. Spending has moved out to the suburbs. So if folks are living out in the suburbs and they're only coming into the city center 2-3 days a week to work, where are they spending money? Where they're buying their lunch, they're going shopping, they're going out, they're going to restaurants out in the suburb. On the right, we show up for the 12 largest US cities. And you can see that early on in the pandemic, there was an enormous drop in city center spending versus the suburbs. So fell almost half. So everyone fled out to the suburbs and they took their credit cards and their spending with them. It's recovered, but it's not recovered all the way there. So consistent with the last slide, people have moved out to the suburbs and spending has followed it. So if you're, in retail or anything that's looking for consumer spending, that is shifted, and it's shifted, permanently. Come back to what Rob was saying. The shift to work from home is now normal. It's stabilized. I was thinking Rob's slide is like the British saying would be flat as a pancake, like across 2023. It's totally flat. Anyway, earlier in the week, someone was saying to me, when we go back to the office, I'm like, we're not going back to the office. I mean, it's 3.5 years since the pandemic. At this point, we have to realize the last year has been totally flat. And so this is permanent. So next slide, thanks. So here we break it down by US city. And interestingly enough, the spending drop in the city centers is much larger in northern and western cities. So places like Chicago, New York, San Francisco, I haven't shown it, but Washington, D.C., Seattle, San Jose has seen some of the largest drops in city centers. I think one of the big reasons is, I mean, like Debbie, this, Rob stuff, this is very much work in progress. It's kind of like premiered here today, but I think one of the big reasons, these tend to be classic old cities whereby there's a central business district in the middle with lots of skyscrapers, then people live out in the suburbs. And that's meant that, there's a clear core and a clear suburb and people have moved out. And that's really pushed down the centers of places like New York. On the bottom, you see Atlanta, Dallas, Miami, Houston looks similar, I haven't shown it. Las Vegas, in fact, is actually up in the center. So these are cities where either they have slightly more tourism or they don't have such a classic center suburb. So a lot of them are kind of, in a sense, more sprawly or more diverse, more spread out. And there you just haven't seen this drop in city center. So there has been a big, move out to the suburbs, particularly strong in big northern and western cities. Next slide, thanks. So finally, there's another skew. So, to be clear, it's not that consumer spending is down. People are spending just as many dollars as they were pre-pandemic. If you look at the trend, we're right on trend. It's that they've moved where they're spending it. So they've moved out to the suburbs to spend money. It turns out they've also moved what time of the day. So what we see is MasterCard data showing there's almost a threefold increase in spending now in restaurants and food that happens in the evening versus the day. So again, this kind of makes sense. I'm working from home. I'm in the suburb. I'm in my house all day or my apartment. I probably make myself lunch. I'm not going to go out. What happens, a lot of work from home people don't take long lunch breaks, actually. They take breaks to do other stuff. So in the data, if you're at home, you're not forced to take an hour to go to the canteen with colleagues. You maybe just actually eat at your desk. You take that hour off to see your kids or go do a chore or go to the dentist or, go to the gym. So lunch has become a much less big deal. But instead, people are in all day and they come to, 5, 6 p.m. and they want to go out. They want to get out of the house. And so what we're seeing is a surge in folks that are actually going out in the evening. Some of them, amazingly, are commuting into the center of town. So it seems a very odd thing. You work from home for the day and then you go into the center of town to go out in the evening. But you see that pretty clearly in the data. So with that, I'll stop and go to our open Q&A. Thanks.
Awesome. Fascinating. There's a bunch of questions that have already been coming through. So I'm going to start pushing a few of them out to you both, and then I'm sure more stuff will come in. If you haven't asked a question, please feel free to do so or give a thumbs up to somebody else's so we can help prioritize. But Nick, I think there was one question around how might market conditions impact the data? You were just talking about the flatness of remote work and time in office this year. We talked about a little bit in the data that I showed. Is there anything in terms of market condition that might substantially move that or change the paradigm in the coming years?
I don't think that much. So again, this is a really fascinating history. So if you went back to 2020, people were very clear in their minds it was temporary. So there were a lot of execs saying, we're going back to the office, don't get comfortable. 21, 22, it starts to creep in. And that was accelerated, that, permanency by the fact labor markets were red hot. So I remember talking to recruiters, one of them, she said, if you're not offering at least 2 days a week work from home, forget it. I'm not even taking on the case. It's so impossible. Just, move on, go find somebody else. I'm not going to get anyone for that job. Now in late 23, I'd say first that it looks like we're going to have a pretty soft landing. So I don't think we're facing a big recession. If we do, I'm optimistic about work from home stabilizing for two reasons. One is it makes firms money. So to be very clear, why all of us in this business, it is profitable to have hybrid. And anything that's profitable is as important in booms as it is in busts. Why is it profitable? Because coming back to what you've shown, employees really like it. The numbers we have, it's worth about the same as an 8% pay increase. So given it doesn't, damage productivity, why wouldn't you do that? So again, firstly, is profitability, I think, is a big driver in booms and busts. The second is there are some industries that have had pretty tough times recently, been laying off, think tech, and they're not calling everyone back to the office. So tech's had a pretty, bad period. They're sticking with, in fact, they are the most remote focused in, in the flex index stuff. You see tech's right at the top. So that they're like, in British saying, the canary in the coal mine. I don't know that's an American saying, but it's like they are in a sense looking into the future. So I feel pretty confident. Again, in Europe, Europe's had a tougher economic time than the US, similar things. You'll see little fluctuations, but this isn't, we are in a new normal. We are not going back, even if there's a recession, I just don't see this changing massively.
Got it. It makes a lot of sense. Debbie, one question that came up, and there have been a couple different angles around this, and I know you've gone really deep at BCG exploring this, is how are you thinking about what types of activities people want to do in the office together, and and how does that, maybe to add a point on what was asked, how does that even vary based on managers or executives versus individual contributors in terms of how they want to spend their office time?
Yeah. So we're digging into this. This is really like live analysis, and some of my team members are on the call right now, and we literally were just going through some slides on this. So it's really live. And chime in the chat, team, if I'm getting this wrong. But one of the biggest drivers is how much your manager cares about you, your day-to-day manager, how much they care about you, how much they value you. How much senior leadership cares about you, how much your organization cares about you. People want to feel valued. Like if you just go back to like self-actualization, right? You want to feel valued. And it makes sense, right? Like if someone says, man, that was really awesome what you just presented, Nick, you feel good, right? Like,
thank you.
Yeah, and I'm genuine. It has to be genuine, not just BS, right? And so it gets back to, and it's just so interesting, like how little we spend on understanding what great leaders look like and building those muscles. And, and training is not how you build muscles, right? Like I say, you don't get in shape by watching a exercise video from the couch, right? Or even going to a spa for a week. You have to identify the routines and rhythms you need every day to do walking meetings and take the stairs instead of the elevator. The same is true for learning how to be a caring, appreciative, recognizing great stuff leader. You have to say, what are the little tricks and tips that you do? Like even sending a private note during a Zoom call to say, oh my God, Rob, that was such a good point you made, or you handled that objection really well, or right, or the lost art of a phone call. I pick up the phone and I'm like, hey, I just saw your work you sent me to look at. Oh my God, it was amazing, right? And so I think those showing of caring, showing of appreciation, showing of support, remembering details about your life are those types of muscles that really make people feel valued, and therefore they enjoy work.
One thing I would add to it, Debbie, I think you've done quite a bit of work on this too, is there is a lot of data and research that shows that the types of activities that people want to do in the office are the ones that are largely predicated around spending time with other people. Put a different way, I want to come into the office because Debbie's in the office. I don't want to go into the office to be there by myself. That's not true 100% of the time, but that's true for a good chunk of people for the most part. And so the organizations I think that are doing this best are stacking opportunities to collaborate live, build relationships socially, professional development discussions, cultural affiliation discussions. Like those are the types of activities where people say that commute trip to the office was worth it. Versus if I go in to do the same types of activities or spend the day on Zoom in the office, then people say, look, I could have done this from home. That wasn't a really good return on my investment.
Yeah, I 100% agree. Like you hear the term earn your commute or be commute worthy day, right? Like to make it worthwhile. And it goes back to the things that drove joy the most were affiliation, right? And culture building and interactive work, right? Those are commute worthy stuff. And that's why the right unit to decide where are we today or next week, or like when and where are we together is the team. The individual deciding for themselves, probably more chaos and less value.
So I want to build on that. There was a question, and Nick, maybe I'll pass this to you, around how important is consistency in policy across teams or across departments within an organization? And I think about even some very visible examples recently in terms of tech workers, for example, at the New York Times and the pushback around return to office policy. But in the balancing of giving teams agency to figure this out for themselves with consistency and application across companies, how should companies be thinking about this?
Oh, that's a big topic that comes up, all the time. But why don't I give you two broad themes that I hear? One is it comes up a lot if you talk to folks in like retail, manufacturing, frontline services about the people at the bottom of the organization having to come in every day. The folks at the top, maybe not so. So I was last week talking to, I won't mention them, but they're a famous manufacturing company. They said they're very unfortunate. Their head office is just across the road from one of the largest sites. During the pandemic, head office is empty or the lights are off because they're all at home. Factories fully open. People are getting COVID. They're like, some people died of COVID. And it's like, oh my God, it's a total them and us. So in many of these industries, to be honest, what that management needs to do is tethered to what frontline staff are doing. So long ago, I had some experience working in retail, and in retail, frontline staff are in store every day. Managers, store managers are in store every day. District managers are. So that's why if you're management in, construction, you're likely to have to go in 3-4 days a week because you've got to connect down. So that's one connectivity that turns out to matter quite a lot. The other one is across groups within an organization. I think, there's two models here. So Stanford is internally, trying to figure this out. It's not obvious. So one model is like Disney. You have 4 days a week, everyone comes in. So the upside is it's simple. If you want a meeting, everyone's there Monday to Thursday, Friday they're at home. It's transparent, it's fair. Downside is there's no choice and you don't make use of office space. So, people are saying the office is, wasting space. The alternative is we're going to let each team choose, or maybe we're going to schedule for teams. So team A, you got to do Monday, Tuesday, Wednesday, team B, Tuesday, Wednesday, Thursday, etc. The letting teams choose turns out to look a lot like the first because everyone pretty much wants to work from home on Friday. Often people then choose Monday, so you're kind of collapsing back to the earlier version. If you schedule, some organizations do that, but there are real trade-offs here. So A, somebody has to be given Friday. It like pisses them off. Like no one wants to work from home on Friday. You're forcing them in. B, there's a reason organizations exist. So you often, there's matrices and you work with other teams and people say, well, look, it's not just my team I work with other folks. And then C, it's actually much harder to enforce. When you talk to senior managers, they don't know who's supposed to be in on which day. So I would say there's no perfect size and it depends on the way your organization is structured. If it's matrix and people work together, I might have a uniform thing. For example, in Stanford, we have different groups that just have no connection. Like, real estate may not really connect with graduate services that may not really connect much with IT. And so they just let them choose team by team, but that's because they make their own decisions. But as Debbie said, within the team, I'm totally aligned with Debbie, within the team, you need to have the same days. That's a kind of, given that the reason that the fastest way to upset people is to have them come in and spend all day on Zoom. Sends them mad. And so I totally agree. The thing that you want people to come in is basically spending time in person together. And so that does definitely mean coordination, at least at the team level.
Yeah. And I'll add to that. Sorry, Debbie, do you want to
I was going to add, like before COVID, there was a big push towards, agile operating models where you have persistent cross-functional teams, even outside of software development. And, flexible work is like the reason to accelerate that, right? Because it, like you said, Nick, if you're in a matrix, well, I have to collaborate with finance one day and HR another day and technical support a third day. Then I just devolve to the lowest common denominator. Like, well, then I got to be in every day because they're in different days, right? So the more you could have people on more dedicated cross-functional teams to deliver work, I think the more you can enable it to work for more people.
And the one thing I'll add, because there was another question I think that was asked around, how does the breakdown in policy vary by size of company, right? And I think that we see typically smaller firms embrace full flexibility at higher rates, right? The percentage of firms under 500 employees that offer employees full choice as to whether they go into the office or not is substantially higher than the percentage of firms that are 30,000 employees or more that offer full flexibility. I think part of that is driven by the complexities that we're talking about in terms of cross-functional collaboration, managers understanding what's happening. But the other part of it, I think, is driven by how did you grow up as an organization? Like companies that have 30,000 people today grew up in a very different world than companies that have 100 people today. And best practice development, we're still relatively in the early innings of. But 5 years, 10 years, 15 years from now, there will be companies that grew up this way and will think about different playbooks for what it means to collaborate and how to spend time together. So to me, one of the most interesting questions when we do the 50th version of State of Flex in 10 years or whatever, however the math works out on that, will be what happened to the small companies that were fully flexible when they grew up. Did they figure out how to scale that and be in the right times and the right days to build relationships and balance office time with offsites and things like that? Or did it get too complex and they moved towards structured hybrid models? The answer to that, I think, will inform a lot of what the future looks like, but it's probably a little too early to say at this point in time. I want to shift to Nick, something else that you went into before around the donut effects. There was a comment that that phenomenon isn't new, right? That in the Detroit, in the post-industrial area, there is a little bit of kind of like donut effect, I think someone had said. Do you think this is just a natural cycle in terms of people move into cities, people move out of cities, they move back in, or is there something more permanent or different around the way that we're experiencing this today?
That's a fascinating point. Detroit is a bit of an outlier. It's kind of like, in economics, Japan and Argentina are always the 2 points. They're on the opposite ends of all the rest of the cloud. So as it happens, if you look at, on average, across all American cities, people are actually moving into the city center from the 80s to 2019. So there's a lot of data showing, I remember as a kid, I'm 50, I visited New York in about, probably must have been 1982 or something, I went on holiday with my parents. And it was so dangerous that we went to the city center to McDonald's on Times Square during the day. And I remember this as a kid, there were 2 guards with open carry guns. Like as a British kid, I was like, I'd never seen guns before, and particularly in McDonald's during the day. I was like, that's because the 1980s cities used to be kind of city centers. There's the crack epidemic and a lot of crime. And so what we've seen is actually city centers have seen more and more density. Prices have gone up relative. So we've seen a 40-year sweep of urbanization. And then that's just ended. So, you could go back longer, actually. It was really interesting. People moved out to the suburbs from about the 30s to the 80s because the car, no Americans had a car in the 30s, basically. There's the mass production of cars. You can now live out in the suburbs and drive in. That keeps going more and more and more into the 80s. By the early 80s, basically, people are out in the suburbs, but congestion started to getting really bad. And so people slowly, particularly young people, are moving back in. So that's the second phase. We're now in the third phase, whereby people have moved out again. So, history is in these long cycles of like 40, 50-year blocks. We're maybe entering, I don't know, the third 50-year block where people then slowly start to move back out again.
It's super, super interesting. I guess we'll only find out over the coming years in terms of how that evolves. One question that came through, and Debbie, this is not something you and I have talked about yet, but I'm very curious to get your perspective on, is this imposed hybrid or more full-time in office structure during the onboarding period, or the term that kind of drives me nuts is the probationary period, which just sounds awful. But how do you think about that as a way of kind of like approaching this and more of a life cycle orientation to flexibility?
Yeah, I love that. I don't love probationary period. It's like, but the onboarding and getting to know people, and I've worked with many clients where, that is where they've moved like whole things to be from home. They still got together from that because the building personal connection with people who start the same time of you, with senior people who are in the role of coach, with senior leaders who come in to meet with you, to really get to know the culture. Absolutely. Absolutely. Like the point is to do it when it matters. Now, if onboarding's really broken and it's a series of self-paced modules that have none of that, well, then don't come in for it, right? It's the equivalent of coming in for a Zoom. But we have to rethink what the work is and how to do the work, and onboarding is one piece of that. And when it makes sense to be together, be together. And even 100% remote companies, rent out an empty office building and be together, right? Like find snazzy places or fun places to be together. You'll form bonds and memories that will last a long, long time.
I love that. And I think I'll point to another piece of research that was done recently. I think Raj Chowdhury at HBS did a fantastic piece on the value in temporary co-location through offsites and activities like Debbie is describing for asynchronous work on an ongoing basis, and that even short periods of interaction improve asynchronous interaction afterward for months on end. One of the things I think that was made very clear to me recently in a conversation also with Darren Murph, who helped scale GitLab, right, as a fully remote organization, is these companies that are doing this really well are not thinking about it as cost savings. They are reinvesting that office investment into opportunities to get together and build those relationships in person. And so the continuum in my mind is not, do we spend less time in office and we're fully remote and that saves money and we never need to get together? No, it's really important to get together in person, even in fully remote organizations that are leading here. They're just very thoughtful and deliberate and intentional around what that times looks like. And maybe to Debbie's point, that's at certain points in the life cycle where that becomes particularly meaningful.
Rob, the Raj's paper was found. Well, I'll give you a 2-minute summary. It was really fascinating because he works with Zapier Labs. And he has data on how much people Slack contact each other. So he has one channel of communication. And he looks at offsites. And he finds that when you go to offsites, they're getting in like 100 people together. People do connect more after the offsite, but it tends to be you link up with people of a similar demographic. So, you can imagine, by gender, by age, by race, they tend to network more, which is, it's not ideal for them. Turns out they also have a randomized rota to catch a minicab or a taxi cab to the airport. And so that's totally random. It just happens your plane's leaving at roughly the same time. And that generates about as big a bump, and it's completely disconnected you're randomly thrown in the cab with people of very different demographics. And he said, the takeaway from it is if you have these offsites, don't let people just mingle in large groups because they tend to mingle with the people they know. You want to somehow create randomized small groups because that's how you get these new connections.
I want to shift back toward something that Debbie talked about before on joy, because I know there's a number of questions related to this topic. I think we all care deeply about finding joy in our work. One of the things that maybe it was Brian who called this out is that mentoring and coaching was the second lowest, I think, on the joy scale, like maybe slightly ahead of admin work. Debbie, what's going on there? Like, why do you think that's the case? Are we thinking about this? Or companies thinking about the importance of those activities in the wrong way, or is it something else?
I think people are really bad at it. I think, that's what it has to tell me, right? Because it's so important. We know it's so important, right? Like you just think about how you grew, right? And who mentored and coached you, but then think about, okay, well, how many people are you actually mentoring and coaching? And maybe you mean to, but you don't have time to do it. So, one of the biggest messages was COVID to be intentional about where and when you work and what you do, because it's just like how many of us let our calendars drive our day and then we let our calendars fill up, and where's the time for mentoring and coaching? And maybe you think you're doing it, but you're not doing it well. So I just think, we could either think about how to grow those bubbles, or we could think about how to embed both the affiliation and culture and the mentoring and coaching into the work we do. How do you make, interactive work like every moment a teaching moment, kind of every moment a coaching moment, like just asking people how you're doing. Like those are new muscles that we need to be intentional about.
I love that.
Too many people aren't.
That's super well put. A different topic. There's a question. Maybe I'll take a first stab, and then Debbie or Nick, if you have direct insight on this, would be curious too. A question around how does the funding situation for scaling companies impact or relate to return to office? Or someone said a few of their clients were finding pressure from funding on their flexibility, and specifically, are they getting together in person or not? I've found so far from talking to a lot of folks in venture that there are very, very strong in different perspectives on this topic. There are some firms that have come out and said, we will not back startups that do not have any in-person time together. Like we believe strongly that is part of the secret sauce in terms of being successful early. I've seen others who think that creates opportunity, right? And they'll go back those companies. And obviously there've been some really successful fully remote organizations. I think the best answer I've heard recently around this was from Hunter Walk at Homebrew, who I talked to on our podcast. And he basically said, we're looking for intentionality, as Debbie just described. I don't want people to fall into fully remote because they think it makes hiring easier, or do full-time in office just because they think that's what we're looking for. I want it to be thought out just like your culture is thought out and your values are thought out in terms of how you're going to approach building a company. People who just fall into fully remote because they think it's easier, he found unattractive. I thought that was kind of an interesting point of view on this. But Nick, Debbie, I'm curious if you've had any direct interactions or gotten feedback on this.
Go ahead, Debbie.
No, I was just going to say, no, I haven't gotten direct feedback. What you say resonates, but I don't have any more to add on that.
The only thing I'd say is this is anecdotal rather than large samples, but from talking to VCs, The other flavor I've heard is some of them are happy with very young, small founding firms, like seed stage firms being fully remote. Their claim is, look, there's 3 of you and you all have, 30% equity or something in it. And they've got, someone else, whatever your investors have got the rest. You're heavily motivated. You know what you're up to. You're still meeting, my neighbor over the back fence is in a startup. There's like 5 of them and they're highly motivated and they work super hard. The story that some of them saying is, look, once you get to 50 kind of plus people, maybe it's a bigger organization, you start to look like some of the bigger organizations Rob, you have in the Flex Index. And there you maybe need more formalization. The tricky thing is, how do you get folks back in the office then? You've only they're not pushing for a full return. It's typically hybrid. That's actually quite a hard kind of pivot to do. And what I generally heard is some of the VCs want them to start hiring around, I don't know, 1 or 2 core cities with a view of moving to hybrid. But for startups, I agree. I've heard mixed stuff, but a lot of them generally be relatively relaxed about it. If you have a motivated set of founders, it's not clear they need to spend money in an office.
Yep, that's well put. One point, Nick, coming back to you on the donut effect. And by the way, I forgot to tell you, I love that you put the small donut on the second page behind the big donut, just to make sure that we keep that theme. It's just fantastic. But there's a question around, is there any impact of perception of safety in kind of dense urban environments that you think is driving some of that movement out, especially in the pandemic, where I think that certain parts of certain cities kind of like changed in terms of quality of life and cleanliness, et cetera, in quite a meaningful way with people out of those areas because offices were relatively closed. Is that having any impact as well in terms of how people are thinking about where they live now?
Certainly, yes, concretely in San Francisco. In San Francisco, it's been has been an issue. San Francisco's serious crime levels actually relatively low. I mean, murder rates are pretty low, but it has a bad perception issue, and a lot of kind of low-level crime has gone up dramatically. There was a fascinating paper at our remote work conference on this. Actually, it was on UK data, but they were looking at all kinds of crimes, and what they show is burglary, household burglary, is down 50%. And it's kind of obvious when you think about it, because there's somebody sitting in the house. They're like in the home office working. It's not very appealing if you're a burglar to break in. And even more so, often they're looking out onto the street. So even if you're not breaking into their house, they're seeing, who's that strange person going into the Perkins house? I see them smashing the window. They're going to call the police. And so criminals are basically moving out from the suburbs. They're moving to where there are less people. The paper is called Eyes on the Street. And I think that's another factor. They're seeing more opportunity because in city centers, there's less commuters, office workers that are pretty fast to report stuff to the police, and there's less eyes on the street. So yes, I think this is a factor actually, that where there are people that are kind of regular law-abiding citizens, they tend to, reduce crime and report it, which is unappealing for criminals. And they're more in the suburbs and less in the city center.
No, super, super interesting. Debbie, I'm gonna give one more to you, and I think it's probably a good, almost like final or wrap-up topic. There's a question on mindset and the mindset divergence between executives and senior leaders and employees in terms of how to think about flexible work. Any thoughts on how that's moving, how we continue to bridge that gap, especially as it looks like we are kind of like more and more settled into what the future is going to look like in terms of some type of hybridized model? How do we get more on the same page in that regard?
Yeah, data. People reflect so much on their own experience and how they grew up and project that onto everyone else. Like, I can't tell you how many times I hear from very senior, very brilliant, wonderful leaders. Yeah, but the only way to build culture is in person, or the only way to do apprenticeship is in person, because that's how they grew up. And, you have to have data in 2 ways. One, the quantitative data, like Rob, what you and I are doing and our teams are doing to show the different relationships, but also just the qualitative, like walk a mile in the shoes of the dual career, time pressed young parent. Oh, am I talking about you? Right. That's trying to make ends meet. And that's just not their personal experience. And so it's very, very hard to pull out of your own perspective and be in someone else's shoes. But so both the quantitative and the qualitative exposure to data can help. That and experimentation. Like, you're never going to win an argument, but why don't we try? Why don't we try it and measure outcomes, right? And don't measure badge swipes, measure outcomes in terms of productivity and joy, and see, have an experiment, clinical trial.
Yeah, I love it. And I'll share one final thought and then we'll wrap on this. I think the other thing I would love to see executives start to do, and I think we're seeing more of quarter by quarter, is a recognition that even if the exact amount of time in office may move kind of like over time for that company, companies are going to be hybrid. If you are hybrid today, you are very likely to be hybrid in the future. And so commit to that as an operating model and start to invest in it as a practice. How do you get it right? What are the different things that you've got to do to actually make it so that you're going to be successful in this? Don't think about it as a waypoint on the way back to full-time in office. And maybe that starts to shift perspective a little bit in terms of how do you train and develop people and operate the right way culturally. Awesome. Nick, Debbie, a huge thank you again. You're always fantastically insightful and love covering a bunch of these different topics. Thank you, everybody, for all of the wonderful questions. We will both share the chat and the list of questions in case people are curious with afterwards. We'll do a recording as well that we'll send out. I believe the PDF was attached already in the chat, so you should have the slides as well. We will look to do this again in a quarter or so, but thank you again for your time, and I hope you have a good rest of the day and a good weekend.
For having us, always fun.
Yeah, thank you. Thanks very much, Rob. Bye, Debbie.
Bye, guys.
Bye.